Just say NB. So NB. So we're writing this NB. The cost of existing ordinary shares. The cost of existing ordinary shares into bracket. Already issued shares. Already issued shares. Close the bracket. Close the bracket. Close the bracket. Is the same as the cost of the retained earning and will be given by the formula. And will be given by the formula. The formula remains KE. Just want to remind you this. DO 1 plus G over PO plus G. You see, that is what we mean. That the cost of existing ordinary shares, the cost of existing ordinary shares into bracket already issued shares, already issued shares. You see, the existing ordinary share, they are the already issued share. That cost is the same as the cost of the retained earning. Is the same as the cost of the retained earning. When we were computing the WACC, you see, we were just using the ordinary share, the cost of the ordinary share, because we know it's the same as that of the retained earning. The formula is that one. Then you proceed and say, for new shares capital, we need new share capital. It will attract flotation cost. And class, just note that when we talk about flotation cost, it is the issue cost. That cost of issue is the flotation cost. So for new share capital, you know you are writing. For new share capital, it will attract flotation cost. Stroke issue cost and discount. Therefore, the cost of ordinary share, will not equal to the cost of retained earning. The cost of ordinary share will not equal the cost of retained earning. Now, I want this to come from you. Between my explanation, or between that explanation, when we are issuing new shares, I want you to compare between the cost of ordinary share and the cost of retained earning and tell me which cost will be higher and which cost will be low. Once you note that, you'll be good. When you are issuing the new shares, and you compare the cost of ordinary share and the cost of retained earning and tell me ni gani itakuwa juu, depending with what you have said. Anyone to save the crowd? Think about it in this way. The cost of ordinary share, when we issuing new, I can see people have started. Just think about the denominator. What is happening to the denominator of this? You see, the formula is the same, but now when it comes to the issue of new shares, that cost, the denominator itakuwa kubwa ama kidogo. Na ikikuwa kidogo ama kubwa, ina affect your cost aje. That is the way you ask yourself. So, will our denominator be bigger or smaller under ordinary share? And a new issue. Will it be bigger or smaller? And how will that affect our numerator? You see, if it is a mixed reaction, the first will be high because no flotation cost. In the second, flotation cost reduce it. Yes, the market price will be reduced. When numerator ni gani? Watu wanasahau. Kwani numerator ni ya juu ama ni ya chini? Tunaangalia ya chini there where we have what? Where we have what? Tunasema bigger ama smaller. Unaona, now when we go to the KE of ordinary share, where we are issuing new shares, this is for ordinary share, it will be DO 1 plus G divided by PO. Then we have to incur some cost here, issue cost, flotation. We have to give some discount. You give discount. What is happening to our PO? It's reducing. So when you compare the PO for the retained earning, remember retained earning, it has nothing that will be affecting it in that order. You see, no, but our PO will be affected. It will reduce. So if this is small, I expect that now whatever the result that I'm going to get will be higher. You know, now the result itakuwa higher. The result itakuwa higher. Kwa sababu hii ni kidogo. I'm dividing using this denominator. Numerator, denominator. I hope now you understand. Numerator si ndio hii ya juu. And then denominator ni ya chini. You understand? Do you understand the concept? Do you understand? Do you understand the cause of the difference? Do you understand the cause of the difference? You need to understand that. That is very important. So under a new issue, the ordinary share will have extra cost of flotation and discount, and those reduces our what? The market value. Those reduces our market value. And now when comparing the two, the retained earning, we say that we first of all do what? We use the cheaper source first. We use the cheaper source first. So in this case, I can see that our retained earning in most cases will be the cheaper cost. Our retained earning will be the cheaper cost. So we first of all utilize that what? Our retained earning before we go to utilizing of the ordinary share. I think with that concept, now when you look at the question that we did, you'll be in a position to do what? You'll be in a position to understand. You'll be in a position to understand. You will be in a position to understand well. Now, class, today I want us to do something under leverage and risk. To do something under leverage and risk. That was just a recap and reminding you of this. Leverage and risk. More of the risk, we shall be looking at them under the portfolio topic, So here we shall measure and on leverage. Here we shall measure on leverage. So you can say that you can define leverage. Let's define leverage. Leverage. Some people say leverage. They depend with the nursery teacher, nursery school teacher. So you say it refers to the use of borrowed fund. It refers to the use of borrowed fund. All debt or debt to increase the potential return on investment. It refers to the use of borrowed fund or debt. It refers to the use of borrowed fund. The first one is fund or debt. It refers to the use of borrowed fund or debt to increase the potential return on investment. To increase the potential return on investment. Yes. In your company, how do you use debt to make sure that your ROI, return on investment, is increased? Return on investment is increased. In fact, we say that it is always good to use debt capital or debt financing in your organization in order to do what? To make more profit. To make more profit. Remember, yes, debt is attached with interest. It is attached with interest. But remember, you're given a certain period of time for you to do what? Before you pay that debt. Before you pay that debt. So why can't you utilize? Why can't you utilize that debt to make more profit before the maturity period? Before the maturity period. So when you talk of leverage, it is the use of that borrowed fund in order for you to do what? To increase the return on investment. To increase the return on, make sure that you utilize, make sure that you use that debt to do projects which are more profitable. And at this point, you know how to determine the most profitable project using the capital budgeting, concept. Using the capital budgeting concept. So don't borrow and maybe undertake useless projects. If you undertake useless project, that means you're not leveraging your what? You're not leveraging your debt. Good. Then let's look at risk. Let's define risk. And I've said that in this topic, we're not going to measure more on risk. You're just defining for the risk and return. We shall be looking at it in the portfolio topic. So let's define risk and say it is uncertainty. It is uncertainty or variability of returns associated with an investment. Just that. Uncertainty. We're not sure. Yes, we have invested in a project, but we're not sure what may arise in between before maybe our project is complete. So there are very many uncertainties. Those are what we calling risk. So risk tumesema kwamba Mary tumesema risk, it refers to the uncertainty or variability. It refers to the uncertainty or variability uncertainty or variability of returns associated with an investment. Yes, you are an investor. You have invested very well. Okay, you've done your research that this is the best investment, but there are those uncertainties. For example, you can take somebody who invested in maybe hotels in 2019. Let's say maybe December 2019. Invested in a very big hotel anywhere in the world. Then, all of a sudden, there was this pandemic. Remind me the pandemic that came in 2020, I think around March. Which pandemic? I think Kenya ilifika 2020. Yes, there was the corona or the COVID. Yes. What do you think happened to such a person? Yes, it was a good project. The person maybe had done research on the same, but there was this risk of COVID, whereby now people are not together. You have to put those, by the way, hotels were closed. Most of the hotels and the bars, they were closed. So those are some of the risks that we are talking about. Some of the uncertainties. So the project will be faced with some uncertainties. some uncertainty. So as you do your forecasting, as you do your research, you need to have a provision for risk. Usikuwe na pressure wakati such a risk imetokea. Usikuwe na pressure in your heart. In your heart, make sure that you have what? Reservation for risk. Reservation for risk. Hatutaki watu wapate pressure wakiwa wadogo. All right. We're going to look at some of the definition under these. Going to look at some of the definition under these. We have 3 forms of leverage. We can state them. 3 forms of leverage. 3 forms of leverage. And the first one is operating leverage. Operating leverage. So we first of all state them. The second one is financial leverage. Then the third one, class, we have total leverage. Total leverage. Total leverage. Just want us to define them. I just want us to define them. Operating, financial, and total. Of course, when we talk about total, is the summation of the two. Summation of the two. We shall see how we compute this. So for the operating leverage, you can say, for the operating leverage, unaweza sema hivi, operating leverage refers to the extent to which operating leverage refers to the extent to which fixed cost refers to the extent to which fixed costs are present in company's cost of capital. Fixed costs are present, are available in the company, what? Cost of capital. Cost of capital, full stop. Full stop. Then you continue and say that it measures the ratio, it measures the ratio of fixed cost to variable cost. It measures the ratio of fixed cost to variable cost. Full stop. You continue and say, a higher operating leverage. What does it mean if we have a higher operating leverage? A higher operating leverage means that a company has a higher proportion of fixed cost. Remember, we are looking at the ratio of fixed cost and variable cost. So we say that a higher operating leverage means that the company has higher proportion of fixed cost, comma, which results in a greater impact on profitability from changes in sales volume. I'm repeating that statement. I'm repeating that statement from the start. Operating leverage refers to the extent to which fixed costs are present in a company cost of capital, in a company cost of cost structure, in a company cost structure. Full stop. It measures the ratio of fixed cost to variable cost. It measures the ratio of fixed cost to variable cost. Now, at that point, somebody can give me fixed cost of your choice. Give me one fixed cost that you know. Fixed cost. Fixed cost. Somebody? So you'll be looking at the ratio of fixed cost to that of variable cost. Fixed cost, yes, Sami is giving us rent. Yes, rent. Rent is a fixed cost. Variable cost, salary. Does salary fall under variable? Wages. Electricity. Like nowadays, electricity you cannot even predict. Lakini imerudi 4. Iko 4 point something ya 100, si ndio? 4 point something. Ya 1000 imerudi 30, ilikuwa around 47. Sasa hii sijui kama okay, ikatoka huko kitambo. Electricity bill is a variable cost. Sasa hii najua imerudi 30 something, 1000. No, is it 1000 or 2000? But it is not fixed. It's a variable cost. It's a variable cost. Therefore, we shall be this operating leverage help you to do what? To get that ratio of cost, the fixed cost and the variable cost. Then you put a full stop and continue and say a higher operating leverage means that the company has a higher proportion of fixed cost. Yes. So tunaangalia hiyo ratio, we must have a numerator, denominator. Unaona? Fixed cost, which results in a greater impact on profitability from changes in sales volume. Are we together? As far as operating leverage definition is concerned? Kwa pamoja. So hapo unaona vitu tatu kuna volume, kuna fixed cost, kuna variable cost. The last sentence, last point tunasema kwamba a higher operating leverage means that a company has a higher proportion of fixed cost, comma, you just put the comma. Do not write comma. Just comma. Which results in a greater impact on profitability from changes in sales volume. So you're looking at the ratio of fixed cost and variable cost, and then there is volume. There is a sales volume somewhere. There is sales volume. Sales volume. So hizo ndizo terms zenye shall be looking at. Now, degree of operating leverage. Now, we want to see how is it measured? How do we calculate that? Degree of operating leverage. Degree of operating leverage represented with $. So operating leverage is measured by degree of operating leverage, $. Operating leverage is measured by $. So I want us to see how. So you say that the degree of operating leverage can be calculated as a percentage change. $. Is calculated as a percentage change in operating income, percentage change. You remember the change, that symbol, in operating income, percentage change in operating income, percentage change in operating income, divide by the percentage change in sales. Divide by the percentage change in sales. Percentage change in sales. That will be $. Percentage change in sales. Percentage change in sales. Good. Then we go to the next one. Financial leverage. Financial leverage. Financial leverage. Financial leverage. Songa kiasi. All right. Financial ndio pili. Financial leverage. Financial leverage. So for the financial leverage class here, financial leverage refers to the use of debt. It refers to the use of debt. It refers to the use of debt to increase the return on equity. It refers to the use of debt to increase the return on equity. Return on equity. Return on equity. Use of debt to increase the return on equity. Use of debt to increase the return on equity. Good. Full stop. Then you proceed and say, it involves using borrowed fund. It involves using borrowed fund. It involves using borrowed fund. It involves using a borrowed fund. It involves using borrowed fund to finance operations. To finance operation. To finance operations and investments. To finance operation and investments with the aim of magnifying returns to shareholders. With the aim of magnifying returns to the shareholders. So you choose a project with the aim of making sure that the shareholders' wealth is maximized. Remember, the objective of every business is to maximize what? The shareholders' wealth. The shareholders' wealth. So he's saying that financial leverage refers to the use of debt. The use of debt. The use of debt to increase the return on equity. ROE. To increase the return on equity. Return on equity. Return on equity, it is the shareholders' wealth. It is the shareholders' wealth. So that's why we have gone ahead and said, it involves using borrowed fund. It involves using borrowed fund. It involves using borrowed fund to finance operations. To finance operations. To finance operations and investments. And investment. And investment. To finance operation and investment with the aim of magnifying. Magnifying is to increase with the aim of increasing the shareholders' return. With the aim of increasing the shareholders' return. Good. Good. Let's see how it's measured, how it's calculated. So degree of financial leverage, DFL, degree of financial leverage, DFL. 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 So you say that the degree of financial leverage is calculated as the percentage change in earning per share is calculated this way. DFL is equal to percentage change in earning per share, percentage change in earning per share, DFL. DFL, percentage change in earning per share, divided by the percentage change in earning before interest and tax. Divided by the percentage change in earning before interest and tax. Divided by the percentage change in earning before interest and tax. Before interest and tax. Earning before what? Interest and tax. Earning before interest and tax. So, narration about that, it indicates how much companies' earning per share can change in response to change in earning before interest and tax due to the presence or presence of debt. That's just a point, no need of writing down. So it indicates how much a company's earning per share. It indicates how much a company earning per share, EPS, per company earning per share, EPS can change in response to a change in earning before interest and tax, due to presence of debt, tukiwa na deni ndani, Let's look at the last one. It is a total leverage. Total leverage. The third one is total. So for the total leverage, you just say it is the combined effect of both operating leverage and financial. Pardon last sentence. Hiyo ya mwisho tumesema tu, it's just a matter of picking the high level concept. You say that it indicates how a company, EPS can change. EPS can change in response. To a change in EBIT. Kumbuka hii ni ile symbol ya change. I hope you people remember the symbol of change. Change. Just a triangle. That triangle is a change. Then in earning before interest and tax. Hope you remember that. A change in EBIT due to the presence of debt. Okay, total leverage, we have said it's the combined effect of both financial leverage and combined effect of both operating leverage and financial what? Financial leverage on a company's earning. Just that. Combined effect of both operating leverage and financial leverage on a company earning. Full stop. If you wish, you can continue and say it measures the sensitivity of earning per share. It measures the sensitivity of earning per share to changes in sales. It measures the sensitivity of earning per share to changes in what? In sales. You see, now sales zilikuwa zinapatikana huku, so inajaribu combine. It measures the sensitivity of earning per share to changes in sale. Degree of a total leverage, how we compute that? Degree of total leverage. So we said this utilization of debt, kutumia debt vizuri. Total leverage. It is calculated as a percentage change, in EPS, over percentage change in EPS over percentage change in sales. Percentage change in sales. Percentage change in sales. Percentage change in sales. Percentage change in EPS over percentage change in sales. Percentage change in sales. EPS over percentage change in sales. That's just some literature regarding those. All right. Now, yes, have that. I want us to, you see, for this one, you can still take DTL. DTL can be given by $, times the what? The BFL. So whatever that you get as a degree of financial operating leverage multiplied by degree of financial, this is alternative. Remember, tumesema ni combination. It's combination, so it can be given by like that. So nataka tuangalie mfano hapa. Angalie mfano. You look at a question. Yes, there was a question that was tested in 2018 to 2023. So just look at that past paper of 2023. 2023, was it not December? It is it August or April? We look at it. Yes, August. The August past paper. Let's look at August past paper. August past paper. So can you look at that past paper and somebody to share in the group? Past paper ya August. Past paper ya August 2023. Sote tumefungua question number 5. 5C. Pale. Number 5C. Number 5C. Tuko pale ama bado? Should be there, but at least be able to finish. So are we there? Confirm kama tumefika pale. Sami ako pale. Question number 5. In fact, that question number 5, if you look at part A, that is something simple. You could have passed that. Number B, that is time value of money. In fact, for our assignment, have the two, have hizo mbili. Assignment yenye tutakuwa nayo hizo mbili, part A and B, question 5 AB. Oh. Yes. Hizo sawa. And then question number 2. Question number 2C. Question number 2C pia hiyo iko sawa kabisa. 2C. Andika hizo assignment, tutaenda kuzifanya baadaye. Question number 2C. No. 2B. Yes, 2B. Hiyo iko under cost of under capital budgeting. So let's look at this question. Penda Limited deals with the laboratory accessories. A dropper sells for 500 shillings per piece and has a variable cost equivalent to 50% of the selling price per piece of the dropper. The firm has fixed operating cost of 500,000 and fixed financing cost of 750,000. Further to analysis of the firm revealed that if the firm's sales increases by 10%, the firm's earning before interest and taxes increases by 15%. And if the firm's EBIT increases by 10%, the firm's earning per share increases by 12%. Calculate the following measure of leverage for the firm. Calculate the following measure of leverage for the firm. Measure of leverage for the firm. Good. Now we need to look at this and see how we can handle it. We need to look at it and see how we can handle it. The first thing that they want us to have here is the break-even quantity of sales in unit. Break-even quantity of sale in unit. How do we arrive to break-even point? Break-even quantity of sales in units. Break-even of quantity in units. And then operating break-even quantity of sales in units also. Then degree of operating leverage, degree of financial leverage, and the last one is degree of total leverage. So I think for the first two now we have to introduce the formula. Hizo mbili za kwanza tunafaa to introduce the formula. So this is the formula of getting the degree of what? The break-even quantity of sales in unit. Break-even quantity. Break-even. So you say break-even point. It will be given. Who can guess our formula for break-even? Who can guess our formula for break-even now? Break-even. So you say it is given by fixed cost divided by whatever that the examiner has given us here. You can see we have selling price minus the variable. Do we have variable cost? Yes, we have variable cost. So that you get there, utakuwa umemalizana na hiyo. In fact, now it will help you to first of all compute what? You are the BEP. So from the question, what do you think is our fixed cost? What do you think is our fixed cost? For quantity. We shall be looking at the break-even point for quantity. Fixed cost yetu ni ngapi? Somebody. The firm has a fixed operating cost of, can you see that? Statement 1. Paragraph 1. In fact, it is the last statement. The firm has a fixed operating cost of 500,000. So our 500,000 is our fixed what? Is our fixed cost. Our 500,000 is our fixed cost. Then we have another fixed financing cost. Fixed financing cost. Quinta tuambia pia kuna fixed ingine pale 750. Fixed financing for so for the fixed here we have 500,000 plus 750,000. Now we have to determine what is our selling price. Selling price tumepewa pia. A dropper sells at 500 per piece and has a variable cost of equivalent to 50%. So hapa ni kuhesabu tu. So 50% of that dropper ni ngapi? 50% of the selling price itakuwa ngapi? Si ni nusu ya 500. So hiyo ndio itakuwa variable cost. So variable cost will be 500 minus 250. Na tumepata hii 250 aje? 50% of our sales. So whatever that you get will be your break point. Break even quantity of sale in unit. Hiyo itakuwa gapi? Patie hiyo. Tumalizane tuende kwa hiyo ingine ya quantity. How much shall we get as our break even point for that? Give me that. First of all, add, then divide by 250. Whatever that you get is the break even point in units. Then tuende kwa hiyo ingine. How much are you getting? Sami is getting 500 units. 500 units. Then we go to Roman number 2. We are operating break even. Now this is just for operating. So tutachukua tu anything to do with the operating pekee. Like that. So operating, na najua hii ndio ya operating. So operating itakuwa just whatever that we have, fixed cost ya operating. So it will be BEP ya operating. Quantity operating BEP. Quantity operating BEP. Hii tutachukua, it will be given by fixed cost ya operating divide by what? The selling price minus variable cost, which will be equal to what? Fixed cost ya operating ni 500,000 divide by 500 minus 250. Pata ngapi? Pata ngapi hiyo? Bizane na hiyo ili tuende kwa sasa our major focus here. Degree of operating leverage not 5. Aje? Tuambia it is 500. 500. The selling price is 500. Mary, selling. Ama ni 5. Oh. Okay. Okay, tuone. Wewe unaangalia gani? 500,000. Operating ni, look at the firm has a fixed operating cost of 500,000. BP ni 5. Oh, this one. Okay. Asante. Okay, sawa. 5,000 units. Sawa. Okay. 5,000 units. Wanashangaa. What about nayo hii ingine ni units ngapi? BP ya operating peke yake. Hii ni units. Hii nayo ni ngapi? 2,000 units. So hiyo tumemalizana. Now we can go to the degree of operating leverage. Degree of operating leverage. Degree of operating leverage. Degree of operating leverage. A percentage change, tulisema, can be given by the percentage change or percentage increase in EBIT. Percentage increase in EBIT increase or change in EBIT divided by percentage change, percentage increase in sales. The change in sales. Was that the formula? Was that the formula? Was that the formula? Was that the formula? Hiyo ndio ili tulisema percentage change in EBIT divided by percentage change in sales. Tuko pamoja hapo? Are we together? Just check dull. You are dull. You are dull. You are dull. Are we together? Are we together? Are we together? Are we together? Now, with that, we just check what examiner is giving us. You just check. In fact, here, examiner just gave us some percentages. So we shall just be working with the percentages. So if I look at this, I have further analysis of the firm reveals that if the firm sales increase by 10%, yes, percentage in operating income over percentage change in sale. Yeah, unaona, now I want to elaborate. Unaona, earning before interest and tax, that is what we call operating income. Good. Operating income. Are we together? Immaculate now. So nataka ushike pia, we shall be using EBIT. Shike hiyo, sawa. And then percentage increase in sale. Good. Now, we given analysis show that or reveals that a firm sales increases by 10%. Good. And the firm earning before interest and tax, EBIT, increases by 15%. Sasa, hiyo unachukua to the percentage given na. So, it will be 15% divided by, ina ingine ina increase na ngapi? Ina increase na 10%. Like that. And you are done. And you are done. So, you give me the degree of operating leverage. In fact, you give it in times. So, how many times? How many times? How many times? $1.5 times. 1.5 times. 1.5 times. Good. Then we go to the next one, Roman number 4. It is degree of financial leverage. Degree of financial leverage. Degree of financial leverage. DOF. So for the degree of financial leverage, we just have to use the formula. The percentage change in EPS. Percentage change in EPS over the percentage change in what? EBIT. Percentage change in EBIT. Percentage change in EPS. Na hizo tuko nazo. EBIT already. Sasa tumeambiwa aje hapa. EPS ina change na 12%. Na EBIT yetu ni in that order, it is changing with the 10%. You see, 15%. And if the firm's EBIT increased by 10%, the firm's earning per share will increase by 12. So we have 12 and 10, 12 and 10%, 12 and 10%. So it will be equal to 12% divided by 10%. 12% divided by 10%. Na hiyo itakuwa ngapi? 12% divide mara ngapi? Mara ngapi? 1.2 times. 1.2 times. 1.2 times. And then DOL, the degree hiyo ya total leverage is DOL times DOL times EDOF, degree of financial leverage. So it is 1.5 times 1.2. 1.5 times 1.2. del times del. 1.5 times 1.2. So it is 1.8 times. 1.8 times. So the major thing here, class, is for you to just know the formula. Once you know the formula, itakuwa rahisi itakuwa rahisi kumanuva hapa. Itakuwa rahisi kumanuva hapa. Itakuwa rahisi. Formula ndio muhimu hapa. Formula ndio muhimu hapa. Formula is very important. Formula is very important. Okay. The formula is very important. All right. And that is it. That is it. Okay. So maybe you can go and attempt November 2018, question number 1. November 2018, question number 1. Or if you have that paper, you can open that paper we see. November 2018, question number 1C. 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 Now, at that question, you'll find that we are having now values. We are having values. Tuko na values pale. So go and attempt that. Go and try to incorporate that and see whether you'll be in a position to do what? To finish that. Finish that. So class, I would like us to complete this question. When calculating KP of redeemable preference share, which formula do we use? While calculating KP of redeemable preference share, which formula do we use? That's a question from Kihara. That's a question from Kihara. For the redeemable, KP for the redeemable. Let's cover that in the in topic number 5. Let's cover that. We shall cover that in topic number 5 for the structure. For the capital structure. For the capital structure. Let's start with that of irredeemable. Yes, that one we shall cover in topic number 5. Now, where we shall be dealing with all those, even redeemable, ordinary share, irredeemable, those things. Ziko. Topic number 5. It's a good question. So why can't we write this topic by a question? We write this topic by a question. By a question that was tested in April 2023, and then we go to this topic number 5. Is that okay? Is that okay? Is that okay? And then we go to topic number 5. Is that okay? Is that in order? Is that in order? Is that in order? We finish this by a question. Can you look at April 2023, question number 2. April 2023, question number 2. We brainstorm with that question. Just a brainstorming question. April 2023, question number 2. April 2023, question number 2. Just look at that question. I show you a trick that examiner will bring. Examiner will bring April 2023. I show you a trick there. Somebody to share that question. Does somebody to share that question? April 2023. I want to show you how examiner will trick you. Examiner will always trick you. Better to something to trick you. I'm looking at that paper, April 2023. This is financial management. Yes, you share, said a copy. And this paper is very good. This paper is very good. Yes, said a copy. Send a copy. That paper, ningetaka muende mfanye question number 1 boy. In fact, 1 yote mnaweza fanya 1 yote. Hiyo assignment muweke mahali. Hiyo assignment muweke mahali. Somebody to indicate for me the first assignment tumepeana. Somebody to indicate for me down there under the chat. The first assignment tumepeana. First assignment. Somebody. First assignment. Remember this assignment when we shall be doing division. Tutaziangalia sana. Somebody. December 2023, question number 2 boy. August 2023, question number 5 AB. And 2B. November 2018, question number 1C. Asante. Yeah, and then you add this to your assignment list. Add April 2023, question number 1 yote. Question number 1 yote. So in that, you can be able to do that. Unaweza fanya 1 yote. 1 yote. Yeah, hiyo ni sawa. Now, today I want us to look at question number 2B. I want us to look at 2B. That is a very nice question here. 2B. This is April 2023. Question number 2, boy. So assignment here weekend isha tosha vizuri. If you add that question for April 2023, question number 1, yote. So number 1, yote. So from this question, it says, the following information was extracted from the financial statement of Lembo Limited for the year ended 31st December 2022. We have ordinary share, 750,000 shares of shilling 20, and the value is that. Retained earning, 8% preference share, of 100 per, 10% debenture, that is okay, and the total of the structure. Additional information. The preference share were originally sold in 2014 at 104 per share. The current price is 94, although a similar issue can be made at 89 net. Ordinary shares are currently selling at 38.4 on the security exchange. The debenture was sold in 2015 and raised 96 per unit. The current price is 80, and it is anticipated that a similar issue would also sell at 80 per unit. Corporation tax is 30%. Last year dividend amounted to 3 million, which was 70% of the net earning. The company expects this dividend to grow at a rate of 6% per annum, and the dividend payout ratio remains the same. The ordinary share can be sold at 40, but in order to guarantee success, they would have sold at 35 per share. Wow. Determine or required cost of preference share, cost of ordinary share, cost of debenture, Max Zabure, market weighted average cost of capital of the firm. Good. This was a very nice question. It was a very nice question. It was a very nice question that attempted to disturb the mind of many students. It attempted to disturb the mind of many students. We are to come up with the cost of preference share class. 1, cost of preference share. I told you that the important thing under financial management is for you to know the formula. Is for you to know the formula. Now, can you give me the formula of our KP? KP, please remind me. Formula of our KP. Formula of our KP, please remind me. Formula of our KP. It is PD over market value. PD, preference dividend, preference dividend over market value. Market value. Preference dividend over market value. Now, I just have to check. How do I get my preference dividend? I have to check information talking about what? Talking about preference share. So you have to just come here and check 8% preference shares of pani ngapi? 100. Remember, for us to get preference dividend, ni kama vile huwa tunapata interest. How do we get interest from loan? Unachukua the interest rate times the par, the loan borrow, that par. So it will be 100% times, no, not 100, but 8%. We told its preference dividend is 8. So it will be 8% or 0.08 times 100 divided by market value. Now, the challenge was here. The challenge was to determine the market value. What is the market value of a preference share? Examiner attempted to disturb the mind of these students by giving very many information, so many information to disturb the mind of these students, and they were very much disturbed. Now, class, can you tell me which price are we going to use? Which price? Market value. Which price? You see, we've been given some literature there which are confusing. Aha. Now me anasema 89, Ida anasema 94. Now, remember what we said. Remember what we said. It is the current market price. Current market price. The current. Wachana na hiyo sijui 2015, sijui what they are saying, sijui net. Those were just information to disturb you. So 94 was the price. 94 was the price. And with that, you could have gotten what? Could have gotten your KP. So can you give me the KP? Give me the KP. Then we go to KD. Or KE. What is our K? What is our KP? Unapata ngapi? Patia hiyo. Then we go to cost of ordinary share. 8.51. 8.51%. 8.51. 5%, 8.5%. Now we're done with that. We go to number 2, the cost of capital, cost of ordinary share, cost of ordinary share. I know that for me to compute the cost of ordinary share is KE is equal to DO 1 plus G divided by PO minus F comma equal plus G. Good. Now, from the question, you just check. Just check. Do you have those items? Do you have those items? If I look at my ordinary share, nimepewa information hapa yenye inaweza changa kabisa. I'm told ordinary share 750,000 shares. Those are number of shares. Of sharing what? 20 each. Good. It's a good thing. They have given me the 750,000 and the value of this share is 15,000. That is okay. That is okay. That is very okay. Now I need to determine my DO. I go to additional information where they are giving me information regarding what? The ordinary share. I'm told that last year's dividend amounted to 3 million. Which was 70% of the net earning. The companies expect this dividend to grow at a rate of 6%. Now, at least, imeanza kupata afueni. Since I have G, G is equal to 0.06. 0.06. That is my G. Hope you can see that. That is our G. So now with that, I'm very happy. I'm very happy. What is the current market price? Market price, my PO. My PO, just check from the question. Ikishapata hiyo, nitakuwa najua nimebakisha kitu moja. My DO. What is the market price of ordinary share? Market price 38.4. Yes, if I look at additional information number 2, nimepewa 38.4. Yes, 38.4. Good. Naendelea vizuri. Nishapata G, nishapata my PO, but I don't have the DO. DO ndio natafuta. But kuna information which can guide me. I've been given dividend per share. The examiner amenipatia dividend. Na dividend yenye nimepewa hapa ni 3 million. Ni 3 million. How do I get dividend How do I get dividend per share, by the way? How do I get dividend per share? Having been given total dividend of 3 million. Total dividend is 3 million. Total dividend is 3 million. And I have number of shares. Can I get DPS? And that will be our D that we want, our DO that we want. So DPS is given by total dividend divided by number of shares. So hiyo ni formula ingine mpya yenye imefanya nini? Yenye ime-emerge. So with this, I have 3 million by number of shares, which is 750,000. So that I get my DO. Haya, itakuwa ngapi? What is our DO? Once we get that, we shall be good to go. What hiyo tutakuwa sawa. What is our DO? 4 shillings. So with that, we are able now to compute our KE. With that, we are able to compute our KE for, you can just put for 1 plus 0.06 divided by 38.4. Atuna flotation, and then we add 0.06. What will be our KE? What will be our KE? Trick ilikuwa hapa. 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 Kwa sababu hizo zingine ziko direct. Ziko direct kabisa. Haya. What will be our KE? Then we go to the next one. The next one is they want us cost of debenture. Yeah, cost of debenture ndio itakuwa next. Cost of debenture ndio ya tatu hapa. The cost of debenture. Cost of debenture. Cost of debenture. 17.04. 17.04%. Asante. Asante. Then cost of debenture. Remember, when you hear of debenture, let's telling in your mind, we have redeemable and irredeemable. When we have maturity period, that is redeemable. So let's check. We were told 10% debenture, sawa. 10% debenture. Any information regarding debenture? Number 3, the debenture was sold in 2015 and realized 96 per unit. The current price is 80. So 80 is the key for me. 80 is the key for me. And it is anticipated that the similar issue would also sell at 80 per unit. Corporate tax is that. Sasa, any other information regarding the debenture? Any other information regarding the debenture? Any other? Shall we be dealing with the redeemable or irredeemable debenture? Is it redeemable or irredeemable? Is it redeemable or irredeemable? Somebody here? Tumepewa period mahali. It is irredeemable, so no period. So for the irredeemable debenture, KD irredeemable will be given by interest over market value times what? 1 minus T. So interest already we are told that this debt need 10%. So it is 0.1 times 80. That is the market price. Na tuliambiwa hii market price ina change ama change, high change. Whatever our market value haita change 1 minus 0.3. Na hiyo utakuwa umemalizana na you are, utakuwa umemalizana na you are whatever. Sasa trickiness nayo hapo ilikuwa to identify that the market value was the same as the par. The market value was the same as the par. Yani hizi vitu tu ni rahisi. Unless you want to complicate it. Unless you want to complicate it. Unless you want to complicate it. And you can give me my KD. Give me my KD as we wind up, as we finish up this. What will be the KD? What will be the KD? KD itakuwa ngapi? 7%. 7%. Now I have my cost of the 3. Why didn't I look at the cost of retained earning and it is provided? Bonus ija shindanilia na hiyo. Cost of retained earning, bona. As we were starting this class, I told you that the existing shares, all the issued. Yeah, there's no new issue. Hakuna mambo na flotation. So therefore, whatever that even if we compute, tutapata tu the same. Kwa sababu formula sasa ni hii. Iko wapi yake? Iko wapi? Ni hii. Tutapata tu the same. There's no issue. So need to understand. So let's get the proportion or weight. Proportions. weights. So tunaweza anza tu na yenye tuko nayo hapa juu, cost of KP, preference share. Preference shares. Preference share, value ya preference share ni ngapi? Preference share ni ngapi? Value ya preference share ni ngapi? I can see that the par was how much? The par was given as 8%. No, 100. The 80 is the current price. Sami anauliza swali mzuri. The 80. So Sami tuangalie pale vizuri. The current price is 80. Anticipated that the similar issue would also sell at 80 per unit. At 80 per unit. So that means the par, our par was the same as the current price. So already tumejua market price ni 80. So the par value still ingekuwa 80. We together Sami. Haya, preference share tuko na 5,000 pale. Par value ni 100 and market value tuko nayo hapa. Iko wapi preference share? Market value 94. Haya, pate something. Then twende kwa next one, hii ordinary share. Ordinary share class hapa niko already na my number of shares 750,000. So hii nita multiply tu na the market price, the current market price which is 38.4. And then twende kwa debenture value ya debenture, value of debenture. If I look at it, it's in fact hii ni kama 1 times that. Hii sasa debenture ni ngapi? Niangalie tu debenture yetu hapo vizuri. Debenture yetu ni ngapi? Debenture hatukuwa na pa. Debenture hatukuwa na pa, si ndio? Debenture hatukuwa na pa. Debenture we did not have par, right? But now after computation, ama after what they have told us, tumeona par ni ngapi? Ni 80. Tumeona par ni 80. So our debenture itakuwa namna gani? Debenture yetu. You can see we have a value of is it 75 ni nini? Kuja kidogo. Debenture yetu we have 7,500, right? 7,500. Yeah, it's 7,500. And we don't have par in this case. So do you think our debenture itakuwa affected kweli? 7,500. Itakuwa affected kweli? Will it be affected by anything else kweli? If you look at our debenture hapo, itakuwa affected kweli? Sioni kama itakuwa affected by any other thing. Because even this market price, the par was not there. Wametumia market price kama nini? So our debenture will remain the same. So nipatie the value of ordinary share na preference share. Ordinary share na preference share. Ngapi? Ordinary share na preference share ngapi? Bona ordinary share hatujatumia par. Hatujatumia par kwa sababu just check. Just nataka uangalie tu vizuri. Why do we use par, by the way? A good question from Immaculate. Why do we use par? Why do we use par value? Niliwaambia kuna hizi vitu tatu Kuna par value, kuna value of share, na kuna number of share. So the moment tumepewa number of share, hii ndio tunatafuta hapa. Here we need to get the number of share. Naona hapa. So preference share number zake zitakuwa this. Divide by par. Find number of share. Yeah, we're looking at number of share. Now, for the ordinary share Immaculate, already we are given 750,000 as number of shares. Sijui kama umeziona pale. hiyo tumepewa number of shares 750,000. Immaculate Hope, unaona hiyo 750,000 shares of 20. So hatushindanili kufanya nini? Kutafuta, because already we have number of shares. Udia share tuko na number of shares. Number of share. Na sasa hapa that means number of shares ilikuwa the nini, because pa ilikuwa 1. Kwa debenture pa ni kama 1. So hizi ni kama the shares available, the shares available. Sawa. So uze total hapa, preference share ni ngapi total? Preference share ni ngapi? Preference share tunapata ngapi hapo? Si ni 50 times 94. 50 times 94, kwani mnapata ngapi? 50 times 94. 4700? Yes, 4700. Hiyo ingine nayo hii ya this one takuwa mingi kabisa. Hiyo is it 750,000 times that? How much are you getting? Itakuwa mingi sana kabisa. Okay, ikuwe tu mingi ni sawa. Tutaona vile tutafanya, bora ndio hiyo. 28,800, yeah? 800. Now get the total so that we get proportion. Total ni ngapi? Haya, asante. Total ni ngapi ya hizi? Ongeza hizo tatu. So we are winding it up. We are winding our session. Remember the last thing will be computation of 𝗥𝗖𝗠 41,100,000. So let's get a proportion hapa. 47 divided by 41 to 2 decimal places. Maybe 0 point. 2 decimal place sawa. 2 decimal place sawa. Tumalizie. 4700 divided by that 11. Haya. Next one, 2 decimal place. Hiyo ndio itakuwa mingi. Audience share huwa inabeba. Sijui kama umeona kwa maswali zote zenye tunafanya, hata kwa unaweza jimakia na ukute kwamba these things ushapata. 70. And then ya mwisho ni 100 minus that. Itakuwa 0 point ngapi? 18. Sasa ukiwa na hiyo, ukiangalia hiyo unakuaga 1. So WACC is what they want. It will be weight of equity, cost of equity plus weight of debt plus cost of debt plus weight of preference share, cost of preference share. So tunazichukua hizo zote. Equity iko wapi? Cost of weight of equity iko wapi sasa? 0.70 times 0.1704 plus weight of debt iko wapi? 0.18 times cost of debt 0.07 plus twende kwa hii ya mwisho, preference share ndio hii 0.11 times 0.085. What is our to 2 decimal places? Give me the 𝗥𝗖𝗠. Give me the 𝗥𝗖𝗠, and then we call it a day. What is our 𝗥𝗖𝗠? So to 2 decimal places, then finish it up. Yeah, 2 decimal places. Who is getting to South Africa very fast? Very fast. Speed and accuracy is the key. Who is giving us that? So we wind it up. Haya. Malizia hiyo tukisonga 14.22%. 14.22%. Asante. Asante. 14.22% from Naomi. Thank you so much, Naomi, for giving us all those. You're the one who have given us all those. That is very good. That is very good. So if you are to find a winner of today, you are the winner. You are the winner of today. You are the winner of today. So class, I think that is marking the end of that topic. That is marking the end of that topic. We shall be starting with the next topic coming next week. Please go and work on the assignment. Go and work under the debenture. We are multiplying 1 times 75. Songa tena. So Elijah Godho ameuliza under the debenture to multiply 1 times. So it's like we don't under the debenture we don't have. We need to do another question for WMCC. Yeah, now that one we shall be doing like revision. WMCC, revision. Once you come across such a question, hizo ndizo maswali tutafanya wakati wa kama Saturday hivi tunatafuta Saturday moja tunafanya. Are we together, Mercy? So, one, it's like our par value. Our par value was, we did not have par value for the debenture. We did not have par value for the debenture, and therefore this value of share could be the same as the what? The number of share. Value of share could be the number of share. Hizo vitu tatu tulisema watu waelewe vizuri, ya? Watu waelewe vizuri. Sawa, Elijah. Hizo vitu tatu: value of share, number of share, and par value. So if you have par value of 1, and the value of share is 7,500, what would be the number of share? So you see, hakutakuwa na any difference mahali popote. Are you getting Elijah? You get the point? There will be no difference, because if I want to get number of share is equal to value of share divided by what? Par. Divided by par. So if I get the value of share 75 divided by 1, it is just 75. So watu wafanye practice kabisa. Make sure you do practice. Utilize your weekend well, and Monday, and also Monday. Utilize your weekend. Your weekend goes up to Monday. The weekend starts today up to Monday. So make sure that you utilize that very well. You do your work. Do the assignment. Share in the group. And with that, by the end of the day, you are the gainer. You are the gainer. So next time we shall be starting on the valuation of asset. Topic number 5. And before we break, I'd like to know if all of us are now through with the theory, because I want us to do this. Next week or next week but one. The three topics of theory we shall be completing. Tutazipitia na nyinyi pole, and then done. Tukifanya topic number 5, sasa tutakuwa tukishafika topic number 7. So tutakuwa tumecover hiyo content yote. Tuanze 8, 9, 10, 11, 12, 13, 14, done. So that is it. Have we finished? Tumemaliza topic 1, 2, 3 summary. Just short notes. Tumemaliza. Let me see by a show of Y for yes whether tumemaliza. Ili I can share some other few tupitapitie, then next time mimi na plan nakuja tunamalizia hizo. Are we through with that? Are we planning to be through this weekend? Maybe there are those who are still in topic number 3, maybe. Almost. So that means what of a new student? Oh, Mosambi is a new student. Our class representative will share those topics. There are 3 topics, notes for the 3 topics. But for the new student, make sure that you are also connected in the learning management system. We also have some notes there. So revision material are printed. So that means next week tunapanga topic number 5. Topic number 5, valuation of business assets. And once we are through with that, tukimaliza hiyo tutapanga siku ya theory. Tutaona kama ni Saturday moja tuchape hiyo theory vizuri tukiwa pamoja. I just share the screen. I just share those notes. I display. Then I select a person to take us through, tell us what you understand, like that. Theory haina formula, so that is the way we are going to do what? That is the way we're going to do the theory part. Otherwise, I think that is marking the end of our today's class. Thank you so much for having time to attend our class.